Welcome, everyone, to another episode of Tax Talk Unfiltered. I'm your host, Spencer Carroll, CPA, and joining me once again, we have Rachel Richards, CPA, our head of product here at Gelt. Thanks for joining, Rachel.
Happy
Excited
to
to have
be
you back.
here.
Yeah, and today, this is episode 10, if you can believe it, and we are in January, and that's what we're talking about today. Q1. You can take a deep breath after the holidays. It's a brand new year. Everything from 2025 we can leave behind. 2026, we want to start fresh and we want to start that year right, and we want to help you avoid any costly mistakes. So today we're addressing business owners, high earners, real estate investors, basically our client base who we help here at Gelt tax plan and strategize to reduce your tax bill. And we want to help listeners in this episode just get set up for success and make sure that you're not going to miss out on any of those potential tax savings. But also at the same time, I think Rachel's going to touch on, we've got some time still, right? It is January, and so we've got the rest of the year. And so there's some things that we want you to pay attention to and make sure that we're setting up correctly. But then there's going to be some other things that Rachel's going to advise. You've got some time to figure out, and time is your advantage, and you should take that, and then we'll figure out exactly what we need to do Q3, Q4. So, Rachel, if that sounds good to you, if you have anything to add, feel free. If not, I'll just kind of open us up by asking you, why does Q1 matter? Maybe let's start with the things that people should be paying attention to early on so they don't cause any mistakes.
Yeah, so in Q1, at the beginning of the year, the most important thing is you just want to make sure that you're setting yourself up for success for the rest of the year. So that means keeping clean books, thinking about the things that you want to do during the year, the things that you expect to happen, the tax strategies that you plan to take advantage of. And with each of those tax strategies, assess like, is now the time for me to take an action, or is that action going to benefit me more later on? So, for example, if you own your home and you've been thinking about using the Augusta Rule, the beginning of the year is a great time to set up that contract with yourself, to look up what the fair market value would be that you'd rent your home to yourself. But you don't have to have all 14 meetings or use your home for all 14 days in the beginning of the year. This would be the time where you say, okay, I'm going to have a quarterly retreat and these other 5 events, and kind of plan out what you want to do. But that doesn't necessarily mean you have to do everything. So Augusta Rule is a great example. And if you want to see the tax savings, you can actually use the tax calculator that we are releasing, we either just released or are releasing very shortly, right on our website.
Yep, exactly. The Augusta Rule calculator will be out soon, and so you'll be able to plug in all those hypothetical numbers that you think are going to be achievable, and you can see the real savings that we estimate could happen for you. So great points. Bookkeeping, Augusta Rule, and I know I talk to a lot of clients that have maybe simpler businesses in terms of transaction volume, and so the bookkeeping isn't quite as heavy of a lift, and so they try to do it themselves, some more successfully than others. And so if you found 2025 kind of being a pain and like, I got to go back and do like 3 months worth of bookkeeping right now, or your CPA Gelt or you've got another CPA is turning the books back to you and being like, these are a mess, I can't handle these, you need to go clean it up. The beginning of the year would be a great time to go find a professional bookkeeper that you could engage with who's going to keep your books up to date on a monthly basis instead of delivering them this huge catch-up project that they're now going to have to work on, and that can take.
There's literally no better time to start than the
Yeah.
beginning of the year.
Yes, exactly. So Augusta Rule, you mentioned. What about for clients who are real estate investors? Is there anything that they should be tracking, maybe like their hours?
Yeah, so if you're a real estate investor, if you think you might be eligible for real estate professional status or one of those other advantageous real estate statuses, if you're invested in an activity that you're borderline on thinking that you might have material participation, now is the perfect time for you to set up a system so that you can track your hours. You can make sure that come tax time next year, you can have all of the documentation ready to justify any election or any position that you want to take on your tax return. So again, you don't have to have all 750 hours in Q1, but set up a system so that whenever you do have those hours, you have a way to track them that's going to make sense to you. And it doesn't have to be some complicated solution. It could even be in your notes. You have a dedicated note where you're going to write down all the days and hours, and then you can send that to your CPA at tax time. But just making sure you have those systems in place so that throughout the year, when it comes time to use them, you feel like you already have a plan and you're not scrambling to find a solution.
Yeah, absolutely. And then shifting gears to business owners, Rachel, before we hopped on the call, you were mentioning to me that there's a lot of things that business owners can kind of slow play, especially in Q1, but maybe one strategy that you do need to have your eye on, whether you end up pursuing it or not by the end of the year, would be entity setup. Could you kind of walk us through who needs to be thinking about creating an LLC?
Yeah. So if you're doing business as a sole proprietor or you're thinking about starting a business, there are a bunch of different options you have and different options in terms of tax treatment. And S corporation is one that is passed around a lot. So you're starting a new business. A common question is going to be, should I be taxed as an S corp? And the answer is when you're just starting out and when you're in the beginning of the year, yes, you should start a new business. You should absolutely open that LLC. But the decision of whether or not you actually make that S Corp, maybe don't make that decision right now. You're just starting out. You don't know what your outcome is going to be at the end of the year. And particularly with an S Corp, the more you make, the more you save. So by slow playing that election, you can wait till you actually know that the benefit of the election is going to outweigh any new compliant costs that it'll introduce. And the IRS offers a late election option. So why not take advantage of that? And wait until you can put everything in place so you're totally set. You have your books kept in good order, you have the entity already created. But whether or not you make that election and decide to file a separate tax return for your business, or continue to treat it as disregarded, part of your tax return, that decision can wait until you have more of the year covered and you know exactly where you're going to end up for 2026.
And what would be the consequences, both time and money, if someone did not slow play the S Corp election strategy, decided to do it right away? Business doesn't quite take off the way they were hoping to. Now all of a sudden they're like, oh no, I wish I would not have made.
Yeah. So it's so common that people will come to us and they'll say, hey, I'm starting this new business. I'm switching from my W-2 job to this contract position. I'm going to be making $300,000. Like, I definitely want to have an S Corp. And they really insist, like, hey, I'm going to open this S Corp right now and we'll make the S election right away. But then 3, 4 months into having that new position, it really doesn't work out for them, and that ends up not being what they want, and then they transition and end up taking another role that's a W-2 employee. And so now they've made this S selection, it's irrevocable, and so they're put in this position where they didn't end up making as much as they thought they did, but they still have to file a whole tax return for this new business. They still have all of this additional compliance where the savings didn't really hit for them. So if they had just set up the LLC but not yet made that election, if 4 months later they decide to do something else, if that doesn't serve them anymore, no big deal. We would report everything on their personal tax return. You pay tax, but no additional compliance or reporting, all of those other things that come with the election. You can avoid if you wait to make that decision until you have kind of all of the information.
Yep. And I see this all too often, I'm afraid, on both sides of the spectrum. I talk to people late in the year, Q3, Q4, who have been operating as a sole prop for way too long. And so they
Yeah, that's the other side of it.
Yep, they never formed an LLC. And so that's why Rachel is saying start your LLC, because when you make that retroactive election, it goes back to when the LLC started, not when the business started as a sole prop. Am I right with that, Rachel?
Yeah.
Yeah.
And the opening an LLC will cost you hundreds of dollars a year, where making that S election is going to cost you thousands of dollars a year. So you really want to be careful. And once you make the election, it's irrevocable for 5 years. So you want to be careful to make sure that that's the right decision. And the IRS does give you the flexibility where you do have the luxury to do that.
Yep. When I talk to the people late in the year that have been operating as a sole prop, I have good news for them, but it's measured, unfortunately, because the good news is, well, you're going to work with Gelt and we're going to get you on the right path moving forward and save you a lot of money. But unfortunately, all this money you've made in 2025, we're going to be a little limited in what we're going to be able to do and impact for the previous year. And when I talk to people who have already had the LLC, all the options are available to them. And so our kind of general recommendation is if you're running a business, you might as well have the LLC because, like Rachel said, a couple $100, it's so easy nowadays online to create an LLC on your own. You don't need a lawyer to do that for you. And at the very least, you're providing some liability protection, which would be good for anybody. But then eventually it opens up the door to some tax benefits as well. But slow play it, because like I said, I've seen both ends of the spectrum, and I talk to a lot of people who have an S corp, and then they're surprised at the cost that a CPA is going to charge them to file for the S corp when their business only makes like $15,000. But unfortunately, it's just the nature of an S corp. It's more complex, and so we really want the juice to be worth the squeeze in that scenario. The savings need to outweigh the cost and the added complexity, because it's going to add a little bit of administrative headache to you as well as a business owner. So, Rachel, anything else that business owners, let's talk about S Corp, because S Corps have a unique requirement where owners have to pay themselves a salary. You mentioned earlier something there that they should slow play as well, since we're just in the first quarter.
Yeah, so coming off of year end, as an S corporation, your salary is so important, and you want to keep your salary low to minimize your self-employment tax. But then sometimes you also might want to raise your salary to meet QBID benefits or to contribute more to retirement. So there are a lot of factors that go into play with your salary when you're just in the beginning of the year. And again, when you don't know exactly how your full year of income is going to pan out, I really recommend just keeping your salary as low as reasonably possible, so that come the end of the year, if you didn't make as much as you thought you would, or for some reason just having a lower salary is really going to benefit you. You can't undo your salary, but you can always give yourself a bonus and increase it later. But because it's the beginning of the year and you have between 9 and 12 months of unknown activity that's going to happen, trying to keep everything as baseline as possible will generally be most advantageous to you as a whole for the year.
And correct me if I'm wrong, Rachel, but when you're a business owner, unlike being a W 2 employee, your W 2 salary that you pay yourself and profit distributions that you might take from the business, they can be lumpy throughout the year, right? They don't necessarily have to be steady, just like W 2 employees receive the same paycheck every 2 weeks.
Yeah. So you're not required to pay yourself on any particular schedule. We have people that pay themselves an annual salary, a quarterly salary, all the way down to weekly. But what you pay yourself as salary is totally at your discretion. And also, what you take as distributions is totally at your discretion. You always want to have a balance between salary and distributions. But if, say, in Q1, you just take distributions, and in Q2, you catch up for the year and give yourself more salary. Those are all decisions that as a business owner, you're free to make. The impact of maybe paying yourself less frequently or less evenly throughout the year will be when you're looking at those periodic financial statements. It might be harder for you to forecast where things are going to be, but as long as you have that number in mind and you know where your pay is going, then that shouldn't be a huge challenge for you. So yeah, your salary is totally within your control as a business owner.
Okay. Good to know. And then sticking with the S Corp, but also introducing partnerships as well. A strategy that both of these are applicable for is PTE or PTET. And so we think about quarterly estimated tax payments when we think about PTE. And so we're trying to balance slow playing Q1 because we don't exactly know how the year is going to progress. But at the same time, we want to make sure we're not missing out on anything. How should folks be thinking about PTE payments? Should they still keep the payment low because you just never know? Is there any risk of missing out on PTE if you do keep it low?
Yeah. So I think with PT, the decision of how much you pay in for PT will probably start hitting mid-year. But what you should be doing at the beginning of the year in those first 3, 4 months is think about, are you planning on paying in using PTE to pay in your tax or not? Because that could affect what you want to pay in as your individual estimate for Q1. So, for example, if you're planning on making a PTE payment and you expect that to cover most of your state tax liability, then for Q1, if your CPA is recommending you make an individual tax payment based on something that happened last year, for your state tax payment, you might not want to pay that because you're planning on having it paid in this other way. And if, for example, you had made that individual tax payment, you can't then change that to become a PTE payment. So you would end up making your individual payment, making the PTE payment from your business, and then any overpayments that you made, you wouldn't get back until you file your tax return in 2027.
Right.
So it doesn't change the amount of tax that you'll end up needing to pay, but the decisions you make in the beginning of the year could affect the timing of the taxes that you need to pay, which actually brings me to something really cool that we do for our clients is what we'll do because we have Q1 estimates and 2025 extension payments due the same day in April. One thing we'll do is we'll usually calculate both of those amounts, but then we pay it all in as a 2025 extension. And the reason that we do that is number one, as an insurance policy, in case for some reason your taxes ended up being way higher than they were expected to be when you filed your extension, you do have a little bit of a buffer there with that estimated tax payment. But then also, if in Q1 2026 we thought that you were going to owe $10,000 in estimated taxes for that quarter, but then when we file your taxes a few months later, the forecast for the year is really different and that $10,000 ends up being way too much. At that point, because we paid it in towards 2025, we can actually ask for it back. Where if you had just paid it in as a 2026 estimate, you're not getting that back until you file your tax return in 2027. So it's actually a really cool tool to kind of leverage. You're not changing the amount that you're paying, but you're changing how you're paying it and then giving yourself the flexibility to potentially get it back if your situation changes.
That's really interesting. I didn't even know that we did that, which is really cool. And the mechanics of that, does it work because when you're due a refund from the IRS, they give you the option to apply it towards a quarterly estimate? So that's basically what you're doing is let's overpay. We'll probably get a refund. If we're correct, you just apply it towards a quarterly estimate. If we're incorrect, you can get it back.
Yeah. So your overpayment from last year's taxes gets treated as a Q1 estimate, no matter if you choose to apply it to next year. And if you don't, you can always get it back. Where if you're making straight estimated tax payments, you only get that back when you file your 2026 return in 2027.
That's awesome. It pays off to work with a strategic CPA, I tell you. Uh, Thanks for sharing that, Rachel. And it leads me to another question. When we talk about the folks that should start an LLC, but we don't know if they should be an S Corp, so we're kind of waiting on that until later in the year. If we decide that the S Corp is correct, does that put them in a situation with PTE where they either decide, assuming they've made all the other quarterly estimates, of course, in my scenario, does it put them in a situation where they either decide, well, I kind of missed out, but that's okay. It's kind of the cost of doing business and being conservative and not wanting to overshoot and be an S corp now that I don't want to be, and I'll just take advantage of it in 2027. Or they have the option to make a PTE payment in Q4, knowing that they have now probably overpaid because they've made all these personal quarterly payments before this. But since it happened in Q4, which is January 15th, as long as they're filing on time, they should get that refund back within 2 to 3, 4 months.
Yeah.
Okay. And then they still get the federal tax benefits of doing the
Yeah,
PTE.
so it depends what state. Some states require, like for example, if in California, if you want to make a PTE election, you do have to make that first payment in June in order to say, hey, this is something that I want to do. But in many states, you can make that PTE tax payment much later in the year, and that's totally fine and won't affect your eligibility. One thing that you do want to think about with the PTE payment is that even if the deadline for making the PTE tax might not be until January of 2026, as a cash basis business owner, if you want to get the benefit in 2025 or 2026, you do need to make the payment in that year. So making the payment for that year is not quite enough. You would want to make that payment by December 31st.
Okay. Yeah, good point. So not January 15th, the due date of the Q4 payment, but actually in the calendar tax year.
Yeah.
Okay, great. And so since we've been talking about this, just briefly, I'll kind of interrupt our interview and I'm going to share my screen to the Gelt homepage. Can you see it, Rachel?
Yeah.
Okay, perfect. Because Rachel already mentioned earlier that we have an Augusta Rule calculator that is coming up really soon. But in the meantime, we already do have a couple of calculators released, and it is for the S Corp election, which we've been talking about, and the PTET calculator, which goes along with the S Corp, or if you have a partnership. And so it's really cool. You can click into here. You can tell us what state you live in, what your business income is, what your salary could be if you don't have a W-2 already. That's going to be a requirement of the S Corp strategy. And your total annual household income. And we're going to calculate the tax rate for you and estimated savings for electing your S Corp. So if you feel like you're kind of an edge case, this could be a good way of gut checking that. And then same thing with PTET. If you already are an S Corp or you're a partnership, tell us what state you're in, your filing status, income levels, and we will also calculate estimated PTET savings for you as well. So check it out. JoinGelt.com, resources, calculators. We've got 2 already, and then we've got 1 on the way with the Augusta Rule. And I believe we've got even more coming. So cool stuff. All right, Rachel. Well, this has been great. Anything else that you think we need to be warning folks about, either to chill out, take it slow, or you need to have a little bit more urgency in Q1?
Yeah. I mean, I think the nice thing about Q1 is you don't have as much necessarily urgency where if you don't do something, you're going to totally miss the opportunity. But the important thing is that you get yourself set up, that you have a plan for the year, that you know what things you want to do so that you're aware when the time comes and it is time to make that decision, that you have all the information that you need and everything set up to make that decision or to execute that strategy.
Great. Well, thank you, Rachel, for joining as always and sharing your breadth of knowledge with us. We really appreciate it. I appreciate it. I learned something new on this podcast, so that's great. And for you guys listening, like, subscribe, comment some topics that you might want us to cover in future episodes. We're always putting out more content on our YouTube, Instagram, LinkedIn. Follow us on all those platforms. We're going to have some future webinars coming up, future tax topics in our podcast. And then, of course, we've got some calculators that we're putting out there as well. So if you follow us on these platforms, you'll be the first to know. Thanks for joining, and we look forward to next time.